As I'm making this recording, the market is soaring. Where do we go from here? Let's find out. I was asked by one of our investment group members to use some technical indicators and see how I would interpret them. One of the indicators that I use is the channel. This is the S&P 500, and this is the channel since 2009. Clearly in an uptrend. This is the sharp March 2020 decline. But if you draw the channel, the trend is clearly up. What is the problem with this indicator? Well, the channel looks great, but I had to wait until March 2020 to draw this line. So this is bad news. So yes, it's a good indicator. It tells you right now that the market is just in the middle of the channel, so it's not a negative picture, let's put it this way. This is the three indicators. One is the MACD. This is the 200-day moving average, and this is, of course, is the S&P 500, and this is an overbought, oversold indicator. The MACD looks interesting when the trends change slowly, gets the top, gives you a signal after the bottom, but the trend after that is persistent, is always a good signal. This is also a good signal. Where the problem arises during a period like we had 2018-20, when the market becomes volatile. Now here is too late because it gives a signal towards the bottom of the market. Here it gives a little whipsaws around 2019, 2020. So yes, it's a great indicator, but only on hindsight. You really never know. The oversold, overbought is nice because it tells you here is the bottom, here is the bottom. During this period, you can rest assured you're going to make money. The problem is here we have a big sharp decline. This didn't tell you. Here we have a sharp decline and possibly a bottom, but this indicator did not give you the oversold level. The 200-day moving average is probably the most interesting one of the three because, as you can see, it just gives you the trend. I call it follow the blue line, and if the blue line goes up, then the odds are that you're going to make money. One of the things that I've done in one of my books is that at month end, you have to watch if the S&P 500 is above or below the 200-day moving average. If it is above, you stay with it. If it is below, you be careful because risk has been rising. A useful indicator is the trend line. It's more an art than a science, actually. When you draw a long trend line and the market breaks below this trend line, usually is a bad sign. Or here, you draw a trend line, if it breaks, is bad news. And one rule of thumb is that the longer is the span that covered by the trend line, the more problem is the market is going to face. So this is used by many analysts. As for instance, here, if you draw a trend line, you know that the market is going to go through a period of consolidation. Is a timely indicator? I don't know. I'll let you decide. But it looks good on paper. This slide shows the S&P 500, the 200-day moving average, and two momentum indicators. This is the advanced decline line of only stocks, and this is the advanced decline line of all the issues on the New York Stock Exchange. And what they do, they confirm the trend. Usually, when you see the advanced decline line making little or no progress, like in this period or like in this period, it tells you that the market going up is losing momentum. So is a sign of caution. And usually the advanced decline lines peaks a few, let's say, months or several weeks ahead of the overall market. So weakness in these indicators means trouble ahead. The 200-day moving average helps defining if the momentum is positive or negative. In the past few days, as of this recording, the S&P 500 moved above the 200-day moving average, with some momentum indicators also moving above the 200-day moving average. So, quote unquote, they confirm that the market is strong. They don't tell you what will be, but just confirm. This is the important thing. This is probably the only indicator that, besides credit spreads maybe, but it's one of the few indicators that tell you what will happen, not what is happening, and is the volatility of the market. There are several measures of volatility. This is one. This, as usual, is the S&P 500. This is the 200-day moving average. Right now, the market is above, as of this recording, above the 200-day moving average, so strong momentum. What volatility does is that when it reaches extremes, it tells you that the odds are the market has reached the bottom, especially when the moving average of the volatility declines. This is very important. It's probably one of the more timely indicators that you can, that I could find out. Even here, when volatility starts peaking out and then declines, will tell you, okay, it's time to become bullish. And then, of course, the market goes above the 200-day moving average, and you stay with it until volatility starts declining. When it reaches this uptrend like this, usually is time you know that there is a period of consolidation coming. So this is a good indicator to follow. Strategists like to follow the business cycle, and this is our proprietary way of showing the business cycle, and it's computed using market data. Here the economy strengthens, and cyclical sectors, and that means industrials, financials, transportations, materials, are sectors that outperform the market. When the business cycle slows down, then you're beginning to see defensive sectors and bonds outperforming the market. Right now, this indicator is very low. At this point, there are some signs that this may be turning up. If it turns up, and I have other video on that, so we would be in a place like this probably. So this is a time, if you have, for instance, as I said, volatility, if you have other data on the business cycle that tell you that this may be a turning point, this is the time that is important to, one might want to consider moving from defensive sectors and bonds into be more cyclical sectors than defensive sectors. This chart shows the S&P 500 and the 200-day moving average. The issue raised by this chart is this a bottom? What we are witnessing in May 2020, is this a bottom of a bull market? Now, then the question is, what happens at the bottom of a bull market? Well, this is the graph, so the relative strength of transportation, retail sales sectors, and metals and mining. What you see at the bottom of a cyclical market, that is when the business cycle is ready to turn and the stock market is beginning to enter into a new bull market, is strengthening of these sectors, which are cyclical sectors. That is, these three cyclical sectors are going to outperform the market. Right now, they are not. Maybe they seem to have some strength, but not all of them. And really, it's nothing to write home about. Quite frankly, it's not. This is pausing more than strengthening. So the point is, yes, this may be a new bull market, but some investors would like to wait for confirmation of these three important sectors to confirm that the economy is turning around and we have entered a new bull market with rising earnings and solid growth ahead. As you know, I published the Peter Dag portfolio, which is available on www.peterdag.com. There are also many videos on that in the homepage that are free, absolutely free. I published a book that was commissioned by McGraw-Hill, Profiting Bull or Bear Markets, and I had real great reviews about this book. 2 more books, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It's easier than you think.